Hi. Tamara, I think you need to turn off your camera. Can everybody see me? I'm a little unclear. If somebody could just write in the chat that you can see me, that would be great. Yes. Okay, perfect. Thank you. Thank you so much, everybody, for coming today, this morning. For some of us, I guess the afternoon for others. We're really excited about this session, Next Generation Skills for Sustainable Finance Education. Really emerged from a collaboration between NYU Stern at the Center for Sustainable Business, where I'm the director of academic research, and also at the Stockholm School of Economics, where Mette Morsing was working, which is now the head of UN Prime. So we're really excited about understanding how people are innovating in sustainability finance, both on the supply and the what are people learning in business schools, and what are we training students for, and what are the skills that business professionals need. So today for this session, we're going to hear mainly about what students should be learning, and we have a number of experts on stage that will be coming on stage. And I just want to make a note, we have a Q&A session, a tab on the side. So if you do have questions, please put your questions over there. We will try to answer them during the Q&A. And additionally, if you would like to see a summary of the findings we have, there's a chat, and you can just put in your email address and we'll send you a summary. So without further ado, I'm going to introduce Mette Morsing, and Mette is the new head of UN Prime. So Mette, come on stage.
Thank you very much, Tracy, and I also want to bid you a very warm welcome to this session here at the GRASFI conference. Like Tracy, I'm truly excited about that we are actually starting to discuss this very topic about sustainable finance in an educational perspective, because it is clear to us that it is a very exciting time for business schools in terms of the sustainable development goals and of sustainable development, not just from the business ethics professor's side, but across disciplines. And one of those very, very important disciplines being the finance area and the Department of Finance and the finance MBAs in our business schools. We know that over the past decade, asset managers have faced increased pressure to account for sustainability when managing their portfolios. The question is if we sufficiently at business school, at management schools, are bringing that knowledge, that expertise into the classrooms to actually help our students and help the financial sector and the finance professionals into the future to be able to address the ESG, environmental, social, and governance issues that they are asked to engage in when they enter practice. So in this session, we will hear from finance professionals about the gaps in ESG knowledge amongst finance professionals, and we will identify the next generation skills needed. So as head of Prime at the UN Global Compact, I'm very excited to have such a high-level experts in this room, in this virtual room, to discuss with me and hopefully set an agenda in discussing this even further into the future. So it is a very big pleasure for me to welcome here Bob Eccles. Bob has generously volunteered to chair this session with us. And as you will all know, Bob is the world's foremost expert on integrated reporting and a true leader of how companies and investors can create sustainable strategies. Bob was previously a tenured professor and professor of management practice at Harvard Business School, and he is the founding chairman of the Sustainability Accounting Standards Board, SASB, and one of the founders of the International Integrated Reporting Council, IRIC. Bob also was a chairman of mine when I was heading the MISM Center or a board member of the MISM Center's board in Stockholm School of Economics. So it is a true pleasure for me to welcome you, Bob, and thank you very much for taking us through the next hour on this truly important subject. Welcome.
Thank you, Meta. I think this worked. Good to see you. I know you're still in Sweden, but you're moving to New York soon. So Justice, looking forward to seeing you in person, maybe someday, moving out of the avatar world. So the format is we will get some remarks from a finance professional. I'll explain her in a moment, and then we'll have a panel and get their input, and then we'll open up to the audience, as Tracy said, for Q&A. So the first panelist, Charlotte, are you there? The finance professional, where's Charlotte?
I'm so close. There I am.
Okay, so here's Charlotte. So I believe a lot in transparency from my work. So I think it's important to practice transparency. I have to admit that there's a certain amount of nepotism involved putting this panel together. Charlotte is actually my daughter, but she's my favorite eldest child, so I thought it would be appropriate to have her join us this morning, given that qualification. She also happens to be head of the real estate book at a fixed income hedge fund in Boston called Bracebridge. And she and I have had these conversations actually over the years about ESG and investing. We had some discussion in Rye this weekend with her 3 urchin children, causing trouble in the background. So we didn't have a full discussion. But Charlotte, I know you've got some things on your mind about education in general for people going into finance and for ESG. So let me just turn it over to you and we'll get your remarks, and maybe I'll ask you a few questions, then we'll go to our panel of professors.
All right, that seems reasonable enough. Well, good morning, everyone, and sort of the new format in which we say good morning to people. Like my dad said, I run the real estate portfolio at a fixed income relative value hedge fund based in Boston. I think my mom still has a note card that says what that is, so she can try to describe what I do. But I've been here for the better part of 14 years, actually. My work takes me sort of all over the fixed income universe. That's really sort of where my expertise lies. So structured products is a really big part of it. I'm part of the team that runs the structured product groups, but also corporate debt, REIT equities, and then commercial real estate, direct assets as well themselves. So it's actually a really nice sort of coverage of the fixed income universe. I'm also very blessed that I am the person here who trades the last bilateral uncleared derivative, which, the nasty world of derivatives is sort of still ongoing, which is very exciting and interesting. I've also, during my tenure here for the last 6 years, I've been part of the recruiting committee. So I've been part of the sort of finance professionals that help recruit specifically for the trading floor for the asset management side of the firm. So I feel like I've sort of seen pretty up close, like what we're, gaps in skills and what we're looking for sort of in the next generation of finance professionals. I think the first thing that I'll say, and this is maybe a controversial thought, I realize there's a lot of academics here. I don't know that academics does a great job in preparing people in general for a lot of the specifics of asset management. I'll get out of the way and say that. I think that a lot of the, finance and asset management that I learned in college, undergraduate at Harvard, was very theoretical and not really applicable to a lot of the work that I do today. It's medical schools maybe a little bit of an analogy, like you're just reading about bodies and books as opposed to being in front of them. But unlike the human body that sort of always has like a pretty consistent set of organs and general setup, financial markets are extraordinarily complex and constantly evolving. I would bet that most people, if they went and pulled down a fixed income textbook right now and referenced a floating rate security, it would say, oh, we use LIBOR, the London Interbank Offering Rate. Well, the reality that I live in right now is LIBOR is going away. It has to go away. There's tremendous political pressure for it to go away. And it's being replaced by a whole hodgepodge of other things that all have their own huge basket of problems. And so it's a really evolving space. So I think there's gaps in sort of knowledge about asset management in general, but then there's also, ESG specifically, there's a lot of issues around there and sort of things that need to happen to make it more effective. And I think one of the biggest ones is the mindset. and a lot of the ways that we think about asset management. Asset management is always characterized around maximizing returns and minimizing risk. Most of our analysis, most of our studies are around that. And the reason for that is that if you become a finance professional and you go out into this wonderful world of asset management, you're going to operate under a model of fiduciary duty and shareholder primacy. I have a fiduciary duty to my investors to make the best decisions for them possible. And under the current constructs of the law, that requires me to always seek to maximize returns for them relative to the amount of risk. That is sort of the construct that we've created. And the way that we educate young professionals is with that mindset. Meta, it was really interesting. You were sort of saying that there's a lot more pressure now to integrate ESG into sort of the mindset for finance. I think that's actually pretty equity specific, and fixed income, which is about twice the size of the equity market, although goodness knows on any given day with where equities are lately, but it's a much larger universe. You have these sort of, occasional green bonds and stuff like that, but you don't necessarily have this sort of real shift in mindset that I think is really important for thinking about how to sort of make this more mainstream. I think that another thing is that we have in general in risk analysis, which again, everything's like risk. We spend all day obsessing about risk. That's our jobs. We have, rating agencies, which have been around for well over a century, that help guide us in our conversations about risk, not only just from an information perspective, but also from a regulatory perspective. Huge amounts of capital, their allocations are set by certain ratings and certain criteria and guidelines. There's a lot of SEC involvement. It's very formal. For ESG, that's still an evolving space, which makes it kind of exciting, but means that you need to be a critical thinker, not just about sort of your own asset management decisions, but about the metrics you're using, where they came from, and how valuable they are. So I actually think that like an ESG, future ESG investors really need like a wider spread, more critical set of tools to be thinking about this universe. It's sort of not only just how to manage assets, how to pick assets, how to manage risk, but sort of the whole framework in which they're doing it, the barriers in it, the opportunities in it, and so on and so forth. And then I guess the other thing that I would be sort of an elephant in the room not to bring it up. If we're talking about ESG and we're talking about the importance of that, finance is an industry that doesn't have a fabulous track record of inclusion. When resumes get to me, by the time they get to me at a fixed income hedge fund, they're already really biased from a gender perspective, from a racial background perspective. The pool that has made it here is particularly somewhat homogeneous. And so where is that? Where is that point at which, women and people of color decided that this industry wasn't interesting, that it wouldn't be a place that they could do exciting things, a place that they wouldn't thrive? I don't know if that's the business school level, if that's the college level. I have a personal pet theory, it's maybe at the high school level. But, I think we really do want to think about how, if we're thinking about ESG mindset, that applies to not only just, the investment decisions you make, but the platform that you make them from in terms of the people you make them with. Also maybe the capital that you are using to make them, the capital that you're investing. I really do think it has to be holistic, which is a huge amount of pressure, by the way, on these, future generations of asset managers. I think this is all really important.
So thank you, Charlotte. Let me ask you one question, and I'll bring the panel up. So we've both seen that video. I went to Princeton, bitch. Remember that video, the guy from Wharton? And so I was like thinking about that video. So if I was to summarize your remarks at the end in terms of the pool that goes into your, it's younger versions, probably much younger versions of myself. Boys that will become old men at some point in time if they last long enough, 50 years or so. They don't really have a lot of practical skills to be in the asset management business. They've been trained in theory. Do they know or care about ESG? Because when I look out there, I see, the Wharton crowd, not to demean Wharton, but, I went to Princeton, bitch kid, the butterfly wings and all that. And then there's the nice ESG people, and they live in different worlds. So when you interview these guys, and the few girls, right? Do they know about ESG? Do they care about ESG? Do they just want to make a lot of money in finance?
So it's an interesting question. I think for Mostly no. Mostly no. I mean, I think most of the people that I interview, the thing that we would geek out about is not ESG, but like Federal Reserve recent policies and politics, and actually like the LIBOR benchmark thing, which seems like a really fringe issue, and we actually think is really incredibly important and interesting. But no, I don't think that ESG is something that people are thinking about or talking about. Yeah, I mean, I will say that one of my female analysts actually has a fair level of interest in it, and she's originally from New Zealand, so that's, I don't know. I have noticed I do manage assets both in America and in Europe, actually a very large European portfolio. Europe, this is talked about a lot more. We tend to recruit out of America because our asset management is based in America, although not entirely, obviously. So, I think Europe is a lot more conscious of this, but no, they're not. But again, to get back to sort of when they get here, when they get in this seat, they're going to be under obligations of fiduciary duty and obligations to sort of maximize return, manage risk. That's really our mandate, is to manage risk. It's everyone's mandate in the fixed income universe. My boardroom went dark.
No, I mean, the whole fiduciary duty, it's an important question. We won't get into it, but this whole Department of Labor guidance that's come out is just being driven by ideology. I mean, the empirical research shows that ESG can contribute to financial performance. And you're right, it's mostly in the equity space, but that's probably another argument. So let me just summarize this up, and then I'll bring up the panel. What you've told us, I think, is important, because we're talking about a narrow pool of applicants that are going into the business, and they've got a relatively narrow lens on it. ESG is not a big part of it. And so I think the challenge for Prime and for Meta and for people who are faculty is that they need to think about both the pool, expanding the pool in terms of the type of people that are going into the asset management business, and also expand their worldview so that it becomes broader than just being focused on the already technically complicated and fast-moving things they have to do. So we'll have some discussion with you and the panel of professors on that. So let me call up the panel. I guess, Charlotte, you can hang around, or
I think I'm supposed to.
Are you supposed to disappear? I don't know. Okay. Well, goodbye, Charlotte. My favorite eldest child is now someplace. I don't know where she is, but there we go. Okay, so why don't we pull up all of the panel? Folks there, Costanza, Tansi, Dave. So I'm going to just briefly, where's Tansi? Okay, Tansi, hi.
Hello.
Oh my gosh, look at your fancy headphones. I'm impressed. So I will briefly introduce the panelists, and then we'll kind of jump in and get their remarks on what they see happening in the way of education for people going into finance. I'll start, she's on the top right hand of my screen, my good friend, Costanza Consolandi. She's a professor at the University of Siena. She's a dear friend and collaborator. We've written a number of papers together. Also, a bit of an odd duck. She's a woman finance professor who cares about ESG. So Costanza, you're like maybe one hand, two hands. I can find folks like you. Right below you in the virtual world is another good friend, Tansi Whalen, who is a professor at NYU. She's doing great work, focused a lot both on companies and investors. She holds great conferences, and she's been kind enough to invite me to host some panels. And I'll never forget that panel, Tansi, where we had Megan Starr substitute for Jonathan Bailey at the last minute. She said, "Don't ask me any political questions," and so I did. Couldn't resist. That was great fun. And Dave, we haven't met. So Dave is interesting. He's both a professor at Kellogg, he's a professor of finance, was a professor at Stanford. He also is CEO of his own asset management company. But Dave, to just be candid, largely I've got you on this panel because we need some gender diversity here this morning. We've had Tracy and Tamar and Tansi and Charlotte and Costanza. We needed, like one token guy. So Dave, you're our token guy in the panel this morning. So thanks for filling in to do that. Let me open it up. What do you see out there in the way of kind of what's being done in terms of education of finance professionals? Are they giving them the skills they need that Charlotte was talking about? Are they getting the kind of skills and background and orientation towards ESG? Maybe we'll start, Tansi, since you've got the fancy headphones. We'll start with you.
Wonderful.
In recognition of how high tech you are this morning.
It's a good thing I have these, because otherwise I, for some reason, come and go in my conversation. So anyway, great to see you, Bob. Great to see you, Constanza and Dave, and also everybody else in the room. So, couple things, you know, and Charlotte mentioned this. Love to see your daughter in action with you, Bob. By the way, you know, this challenge of the focus on short-termism, shareholder primacy, managing to share price, which all students are taught, you know, creates a challenge for the focus on ESG. So you have sort of two countervailing trends, right? One is, how do we begin to focus more on these other issues at the same time you're continually pressed to you know, increase share price, et cetera. And that sets up a tension that's very challenging, I think, for students and for finance professionals. So what do we need to do about that? Well, first of all, I think really important that we teach that sustainability is really just about good management, right? It is embedding sustainability core to your business strategy, whether you're a corporate or an investor. And in doing that, it drives innovation, it drives operational efficiencies if you're a corporation, it drives risk mitigation if you're an investor or a corporate, it drives employee engagement, productivity. All of these things have financial benefits, right? So really understand, if we understand that really this is about better management, more information, ability to do better as an investment professional, then we need to begin to teach these skills in all of the classes that you'd be taking when you get your MBA, in your management class, in your marketing class, in your finance class, obviously, in your accounting class, and so on. And what are those tools that you need to evaluate good? So as an investor, what you need to be able to do is really to understand what constitutes good sustainability management in your investees, in the areas that you're investing in. And there's a number of key issues. Bob, you've worked and been a leader on this sort of question of materiality. Understanding what's material is a critical skill and knowledge base. Stakeholder engagement, being able to listen to and understand who are the key stakeholders in the sort of ecosystem and where they sit on that company is a risk management issue. Systems thinking, understanding, for example, you know, when we look at COVID and we look at what's happened with food and we look at the lack of resiliency because we focused on operational efficiency to the detriment of resiliency in our supply chains, you know, we need to sort of be able to look around the corner and understand what those sets of issues might be from a systems perspective so that we can better manage for risk as well as opportunity. Better understand market demand. You know, we've been doing some research at Stern, and it's been fascinating for me to see that there really isn't actually good market research on actual consumer purchasing of products. So we saw, for example, you know, the dairy sector, the conventional dairy purchases were way down, the sustainable were way up. Nobody was addressing that either at the corporate level or on the investor level. And then we saw Borden Foods and Dean Foods go into bankruptcy. So just as an example, not paying attention as an investor or as a corporate to those trends. And then my final point in terms of skills that students need. You know, one of the challenges that we have is that accounting itself is challenged in terms of being fit for purpose, and that it's really focused less on intangibles, and intangibles are such an important part of a company's value today, as well as such an important part of sustainability. And so we need to do a much better job of tracking the return on sustainability investment by companies and by investors. And investors are currently asking for, and this again goes to Bob's sort of interest in integration, but currently investors are asking for non-financial metrics when they're asking for them at ESG, and then financial metrics, but the two aren't brought together to determine what is affecting what, right? And so that to me, again, goes back to good management. If you don't understand that, you're not making good decisions. And so therefore, we need to teach that to our students so that then when they become finance professionals, their decision-making is much more informed.
So a quick question before I go to Constanza. So you see it from both the corporate and the investor view. Do you see any difference in terms of level of interest in your students in sustainability, whether they're thinking about going into the corporate sector or going into the investment business? And do you think that the qualifications are any better or not for people going into the corporate sector that want to integrate sustainability with financial performance compared to the investment industry? Any differences that you see?
It's easier to understand it and see it in a corporate context, right? So I think that it is easier for students who are interested in these issues to see a way forward. And it's more challenging for people who want to go into finance. Plus, I would say that in most graduate schools, ESG is not in the core finance curriculum. So that's also challenging because they're really not exposed to it at all. So they don't even know what they don't know, I think, is whereas on the corporate side of things, there's a little bit more access to that type of information. On that point is finally what I will say is that that conference that we do that you mentioned, Bob, one of the things that we've learned is that investors and corporates don't really talk to each other or engage with each other too much on the sustainability side of things. And that means that investors don't really understand a lot about what constitutes good practice on the corporate side. And so therefore, I also sort of harp on the fact that that unlike in your traditional financial analysis, where maybe you don't need to understand that quite as much, in ESG, you actually really do. And so that's also you need more of a bridge between the corporates and the investors in education and in practice.
I would agree with that. So let me make an insulting comment about finance professors before I turn it over to Costanza. I think they're the last people that are going to kind of quote get it. I mean, it's amazing to me. I can get a meeting with any asset owner and asset manager in the world. I'm nobody, right? I have a PhD in sociology. I don't have an MBA. I don't have an accounting degree. Everything I know about finance, I've learned from Costanza, Fama, French, regressions. The reason I get these meetings is that you finance people don't want to go talk to them because you think this stuff is all irrelevant, right? Because you've got your portfolio theory and blah, 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 blah. So, I mean, you're like the last bastion of ignorance, as far as I can tell. You're like the major gating factor to what it is that we need to do. So Costanza, with that warm introduction, sitting over there in Europe, I mean, how do things look to you?
Yes, thanks, Bob. It's happy to see you, and hi, Tansy, Dave, and everybody that are currently on the backstage. Yes, so you know me, Bob. So I'm a finance professor, and I'm interested in sustainability. You told this in the kind introduction you made at the beginning. What I think is that as a finance professor, we cannot afford now not to teach sustainability-related topic. But we do not have, I think, to teach sustainability as a part of a course. What it is necessary, as Tansy said, we need to use sustainability as a new lens, and use sustainability as to make students understand that this is how a corporation is managed. I'm lucky because I'm a corporate finance professor. We do not have a course on sustainable finance, but in my course of corporate valuation, I have a module on putting sustainability into valuation. So after they know that I teach my students, DCF, relative valuation, and all the technical stuff, it is okay. Now we can use a new lens. When my students knock at the door of my office, the first thing they see on the door is this wonderful picture of the last World Economic Forum Global Risk Report, where there is the interconnection of the perception of risk, which are non-financial risk. So I think this is essential. And as a corporate finance professor, the first thing I try to teach my students is let's say, which are the mechanism through which ESG performance sustainability is translated into value, so as increased value. So sustainability shouldn't be, an ad hoc part of the course, but it is a new lens. So, and this is something I'm currently trying to introduce in the MS in Finance as a steering committee member of the MS in Finance. I'm trying to invite my colleagues teaching in this course to use this lens also, and to give him the skills. Of course, French and French is fundamental. Students must know French and French, but then they also need to know how, including, non-financial issues is important. Tansy mentioned the materiality topic about, the relevance of ESG. So everything is linked to value creation and how sustainability. And students should have this. As far as from my experience, I started to teach this part 3 years ago. And I must say that the success rate of this sustainability into corporate evaluation class might be measured in terms of the number of applications I receive to be a thesis supervisor. And the majority of topic that students suggest when they apply for being supervised by me are linked to sustainability and are linked to ESG investing. And so this is, I could say, it is a success rate. And another thing in terms of gender equality, another thing is gender inequality in this case. So what is nice, and we probably should study this, I know that in all the conferences related to ESG investing and asset management, that the share of women that are working in the ESG arena is higher than traditional finance. So I think that, gentlemen, you should think about this.
So it's a fair point. I mean, I remember Charlotte once saying to me that it was like sustainability was sort of a girl thing, and then it became popular, and then all the boys wanted into it. And it's interesting to see that the trend is very clear, and you see it both in terms of academia and practitioners. Before I turn to Dave, let me ask you, though, a question about incentives, because this is something that Meta and her group is going to have to grapple with. How difficult is it? I mean, you and I struggle with this a lot when we write papers together and submit them. The finance academic journals, the things that you people have to publish in to get promoted, to get tenure, to become full professors, is the finance, professional finance, academic community, the journals, are they interested in this kind of work or not?
Yes, this is a very good question. Several years ago, if you were thinking to submit a paper related to ESG, or at that time you should talk of social performance or CSR, and you didn't use ESG, a finance journal would reject immediately that your paper. Not now. So now you have finance journals that have special issues on sustainability related topics, and finance conferences that have special sessions on ESG investing and so far. But why this? Because what is changing since in the past is that the finance professor, and because of the increased importance of ESG, and because of the ESG becoming mainstream, we are, incorporating ESG in the traditional finance model. So it is a new parameter to include. We cannot avoid we cannot not consider climate risk as a sort of financial risk.
Look, and in fairness to the finance profession and to the journals, I mean, the challenge has been data, and so I want to give a shout out to the Impact Management Project, and it's another discussion we can't have now, and the great work they're doing. We need standards for ESG non-financial information, just like we have for financial information, like we have accounting standards. And increasingly, there's AI and big data sources that, you and I use and other people use. So, Dave, let me turn it over to you, because, you wear sort of two hats. You're on both, the supply side, and the buy side. You hire people and you train people. So how does it look to you?
Well, thank you so much for having me on the panel. If I give you a little bit of a backdrop, you're right. I'm both a founder of an asset management firm that focuses in on sustainability as our primary investment thesis, and the fact that sustainability creates economic advantage, and that's equilibrium. The second thing is that for the last 12 years, I've taught a very practical-oriented class at Kellogg around sustainable finance and impact investing. And so 12 years ago, this was in many ways the backwater. Certainly the backwater of a lot of what students were interested in, and certainly in finance. And it's interesting that you mentioned Megan Starr, and in your opening remarks in passing.
Who's fabulous.
Megan was actually.
The woman's fantastic. She's a Carlisle now, right? As head of sustainability.
She's a Carlisle,
yeah,
and she was one of my students when I taught.
Oh, when she was at GSB. Okay, yeah, great.
Yes, yeah. So I taught at Kellogg for starting about 12 years ago. But in the middle of that period, Stanford wanted to start their program, and they wanted to start the program in a very practical way as opposed to kind of theoretical. And more than 5 years ago, the center of gravity of teaching of this topic was around advocacy, responsibility, passion. And you could see the shift that was taking place in this industry, where it was moving from the conversation about let's change the world to becoming really a finance profession. And I would say that the financial services industry, and again, this is a generalization, but beginning about, and you can really feel it about 5 years ago, it went from talking to clients, asset owners, about strategy of sustainability to what products do you have? What are the transactions? How are you integrating this into your investment process? And you could see that shift from theoretical strategy to very much a focus on, I'll call it the deal or the asset or the transaction. And it really was a calling for a change in the skill set that was necessary. So if you take and think about that reflection, and you look at, let's take a look at Megan. When she graduated, was right at the entry point of the time when this shift from let's write another white paper to what products do you have? She entered into Goldman Sachs at the time, and almost immediately upon and timing is everything, almost immediately upon timing, and I sort of joke about this, Goldman was at that place where they needed to put strategies onto products, sustainable and impact products onto their platform. They looked around the room, they asked, hey, can anybody here spell sustainability? And she happened to put her hand up and said, I took a class in this. And that was a great time then to go, hey, can you help start putting together what the platform looks like, selecting the products that would go onto this platform, and begin down the process of actually creating products that Goldman would offer to their clients. And so she hit the market right at that shift point. And so if you think about it, what skill sets do we need to give our students? And I'll say things here that in some ways Tensi and Costanza have already highlighted, but I want to give it from maybe an asset manager, a hiring person's perspective. Because the market has shifted from theory and strategy to product, the first thing that we need to be teaching our students is deal structures, the actual mechanics of deal structures. And this reflects also the change in this industry that 10 years ago, when you talk about impact or sustainable, you're probably talking about the venture capital asset class. Today, you're talking about sustainability and climate risk pervading across every asset class and every investment strategy. And therefore, the innovations of deal structuring now and the mechanics of deal structuring have to pervade across the entire asset allocation model. So every asset class is affected, and we need to teach the students the mechanics of it. Math counts. The second thing, and these are two sides of the coin, but the second thing we need to be teaching the students is the risk models for ESG and for climate. And not just at a glib high level, but really at what are the classifications of risk, and what are the classifications of, and how do we quantify the risks in ESG and in climate. And in some ways, Bob, a lot of your writing over the last years, the flip side of your writing is, if I'm not doing that, what am I exposed to? All right. And you've shown where high ESG results in either higher competitive value or competitiveness, and ultimately into the value of the strategy or of the corporation. Well, what's the downside if you don't do that? All right. The flip side of that we need to be teaching is the economics of sustainability. And again, there's a tendency to stay at a very high level when you use those words, but we're now at the level where we need to actually punch down to what's the math of that. So examples of that would be, what's the value of reuse? What's the economic value of a circular economy? Tensi referred to it as systems thinking. But what's the value of externalities, or of not paying attention to externalities, or what's the value of incorporating externalities into your value creation or investment thesis of the transaction? What's the pricing of the value in these advantages? And the difficulty in that second thing that I said that we need to be teaching our students is that we're going to be teaching students this importance at the same time that the tools are being developed. So the academic research, as much as we have the sharp work and others that have been pioneering fundamentals, there's no pioneering fundamental in this field. The good news is that we're starting to get some of the early risk models that are starting to take place. For example, some of the work that's come out of, for example, Harvard and their use with Root Capital are some of the very rudimentary first attempts at creating risk sorting models, and even using the terms that were the efficient frontier and how you adapt that concept. These are now the primordial tools that are being developed. And so the challenge for being a professor right now is we're teaching the math and the substance at a time when the tools and the theoretical hasn't actually caught up yet. But we're forced to do this because the market has now moved from high-level theory to what products do you have? How are you translating this into transactions? How are you doing deals and across the entire asset class? So the stakes the stakes of what we teach are now increasingly important. And the last comment I'll make is that it's because about 5 years ago, I think, that we recognized that there was this shift taking place, that this was legitimately a finance profession, and that there were legitimately unique tools that were necessary for this profession, and that the bar had been raised, and that mainstream finance platforms were building programs around this. The recognition that these shifts were taking place is why we created the Impact and Sustainable Finance Faculty Consortium, which was an attempt to bring together, and today we've got 215 faculty from 106 universities in 27 countries that are coming together once a year at a convening to trade really practical things. What cases are you teaching? What frameworks are you using to teach the students? What's your experiential exercises? What's the basic philosophy that you're teaching and the underpinnings? We're not trying to make sure that everyone teaches the same thing, but what we are trying to do is encourage everyone to continue to up-level the level of education. We're also trying to combine the practitioner-driven professors with the academic and research-driven professors and blend that piece so that we get better and better tool development. So hopefully that helps.
That's very helpful. I mean, and it addresses some of the points that Charlotte raised. If Charlotte isn't trading a derivative someplace, if she could come back again, I want to ask her a quick question, then I'll let Meta ask some questions and we'll open it up. Charlotte, are you around, or are you off trying to make a bunch of money? I'm taking advantage of somebody in a trade someplace. Are you around, girl?
Otherwise, maybe Bob, I could just follow up on exactly where Dave was ending right here, because there's a question from Robin.
And go ahead. I'll let you follow up and I'm going to something. Go ahead.
Yeah, thanks, Bob. We're not finance professionals, but we want to come to your world and help, steer it. It feels impossible to break into, though, is the comment. And I want to, follow up, Dave, with what you're saying with your initiative and the Kellogg initiative here, in terms of how other disciplines beyond finance are entering, and what are some of the good cases and what are perhaps some of the obstacles. This is part of the research that I've been doing with Rachel Belinga, also investigating different disciplines engaging and the difficulties for other disciplines maybe to take part in this discussion. Yet, whilst we've been looking at the courses that are being taught, quite a number of them on sustainable finance, quite a number of them are taught by, you could say, non-finance professors. So please, thank you.
So I'd like to ask Charlotte a question. Dave, you said a couple times, you used the term math counts. And so Charlotte, you were an applied math econ concentrator at Harvard. You've got to be a concentrator. You can't be a major like everybody else. You're a concentrator at Harvard. And you're not as smart as me because I was a pure math major at MIT, which we've agreed to. How much math do you think people need? What are the basic math skills people need, to Dave's point, to go into this industry? Costanza was talking about that as well. What do you need to know? How high of math education?
So I think that it is, it's both more and less than you think it is. And I guess I'll say what I mean by that is I actually don't think the actual math that I use day in, day out is particularly complicated. Huge volumes of it are just some version of discounting, right? I mean, this is just what we do sort of constantly, obsessively is discounting. And Dave, I see you nodding your head. We do this in equities, we do this in fixed income. This is just a huge part of so many. This is like one of the big core things, and it's a little tragic how many people in America don't actually have the sort of the tools to do that concept. A lot of the higher level theoretical math that I did, especially towards the end of my college career, that was for fun. That's not the sort of stuff I use. Linear algebra. My husband and I tried to make a determinant joke the other day with my husband, who's like, you used the word wrong. Like this, it's not really what we use. But what I think is what people don't understand is both you don't need a huge skill set. It's smaller, but you're supposed to use it everywhere, constantly. And I think that's the thing that's really missing is we sort of teach this incredible depth and these sort of very narrow scopes, these pure math scopes, these theoretical scopes. And actually what you need is it's sort of like the difference between having a whole bunch of like really, really specific like kitchen tools, like the avocado one and the apple one and all these ridiculous things. You just need a knife and you need to know every single place to use a knife.
Do you need to know how to code? Do you need to know how to code, or is that just a fixed income thing?
It is. I think I have some friends who are very successful long short equity managers who work with teams who are very good coders, and they don't individually need to know how to code. But I think coding and data management needs to be in every asset management firm in some
Dave,
capacity.
you want to jump in on this?
Yeah, if I can answer Meta's question and yours. When I say math, let me take apart a couple of. I won't go into this, but the basis of the entire renewable energy financing has been about these arcane integration of tax laws and tax equity investing, and so the reason I go into that is the genesis of a lot of this conversation about impact investing and sustainable finance, to Meta's point, came from different places. It came from policy. It came from philanthropy. It came from a number of different, it came from law. It came from a bunch of, and the fact is we need all those perspectives in order to be able to do the kind of complexity that we're dealing with when we talk about sustainability. We need those. But somewhere about 10 years ago, that was the center of gravity of the conversation. So you end up with words like the imperative, the words like sustainability is core to our future. Well, at some point as finance professionals, I got to put together a capital stack. I have to justify why the hell the transaction actually, quote unquote, pencils. All right. And so in renewable energy, if I keep talking about the fact that the earth is melting and I need renewable energy, at some point I have to translate that set of imperatives into a transaction. $800 million have to transact. And that doesn't transact with a lot of white paper and a lot of noise. It transacts with a big spreadsheet. And the spreadsheet probably is a stacked finance capital structure with about 6 or 7 pieces of separate financing, a debt sleeve, a mezz debt sleeve, a tax equity sleeve, and an equity sleeve, and maybe a grant sleeve. All right. And if you're not comfortable with the math, and this is not rocket science math, but if you're afraid of numbers, you can't play this game anymore, because no one's going to invest $800 million and transact an $800 million transaction if you're not comfortable getting down into the weeds of that. You can't keep talking about the law and the imperative and the earth melting. At some point, it's just a spreadsheet. All right. And all of the sustainability economics will translate into some level of quote unquote underwriting that's in the spreadsheet. And our students now need to learn that, or else they can't enter the profession. 10 years ago, you could learn theory and enter the profession. And look what's happening in the financial services industry. The head of sustainability in more and more of the shops is no longer someone that came out of philanthropic or came out of public policy and is in a financial services industry. That head of sustainable finance is now likely to have been a transaction person that now understands and embraces and is wrestling with how to integrate these thinkings. But at the end of the day, the reason that transition has taken place is that individual is now chartered with building products, investment products that asset owners will put into their portfolios. And that's a transactional game.
Let me just make one comment. I'm going to turn it over to Meta. So when you kept using the term sleeve, I thought, oh man, that's such finance talk, right? And it's interesting because there's like two different discourses. There's like a whole language of finance and acronyms and, you know, terms that you use. And there's like a whole language in sustainability that people use. And you've got these two different tribes that need to learn each other's languages as well as, you know, learn each other's skills. So Meta, let me turn it over to you. Do you want to take questions from audience? Or there's some questions you'd like to pursue? I know we're running out of time.
Yes, no, thank you. This was sort of one of the questions that were raised in the chat that I just wanted to sort of pay attention to right here. But maybe I would suggest, Bob, that we take just one sort of comment from our four experts here in the panel about, and perhaps including you, Bob. So what is, if you sort of should very, very brief, one sentence, what is the skill set? What are the most important part of that skill set we need to bring into the classroom of the MBA finance? And perhaps, as someone said in the chat, also the Bachelor of Finance, not just, you know, at the MBA level. What is that part of the skill set that is most important? And maybe we go back and start with you, Tensi. And then we will, sorry, then Tracy has promised to, you know, give us a 2-minute sum up before we conclude this session. So
Okay.
very, very briefly, please, Tensi. Thank you.
Absolutely. And thanks again. This has been fun. One, understanding the material ESG issues for the sectors you're working in. And two, understanding the business case, where the value is being created. And three, the specific financial skills, as Dave said, to bring those ESG elements into valuation, into decision making, et cetera.
Constanza.
Tensi told exactly my points, so she told my points. Yes, what I can add, so I use this minute, just to reply to Charlotte and Dave about, and to answer to Bob about the math skills that are necessary. Well, I think that just in one sentence, the skills necessary for ESG investment industry are exactly the same skills that are necessary for finance, because otherwise we take the risk that, you know, ESG investing would be a sort of naive investment. It is the same thing that if in corporation, when we had the sustainability managers and the sustainability dimension was as far as it is from the board, it is exactly the same thing. It is exactly the same parallel. So the skills we need are the same as for mainstream finance, plus these skills from the sustainability arena and translated in financial language. So this is what I say.
Thank you very much, Constanza. Dave, and then over to you, Charlotte.
Yeah, I think what Bob said earlier about the two languages and the need to merge them, you know, I think that is an incredibly important and, you know, simple but incredibly hard to do thing, and that is integrating the language and the substance of sustainability and climate, and is a great example of that, into the core of the curriculum. It is just another major factor that will drive the economics. And I think if anything, COVID in a funny way showed us that these isolated things that we think of as isolated things, you know, that's a healthcare crisis. You know, we watched how that pervaded every aspect of our society, our culture, our economics, even our natural systems. And I think that if we really believe that, for example, climate change is one of those issues, then we will start to understand how pervasive and systematic it is. And the challenge as a business school professional, as well as a sustainability investment professional, is that these thoughts and now need to be integrated into the core curriculum, because these things are now part of the risk factor and the opportunity set across everything that we do in our classroom.
Thank you so much, Dave. Thank you very much. Charlotte, quick comment from you, and then you finally.
Yeah, I mean, I think I would agree with what everyone said. I think that one of the biggest skills you can give students is the ability to add ESG to their risk framework, and also I think change sort of a lot of the fundamentals of the framework themselves. I think someone said in the chat that a lot of students, financial students in particular, if they have industry experience, are entrenched in traditional values. And this isn't something that's part of that traditional value suite, but as everyone on the panel has said, particularly you, Dave, it's an important part of risk management, and shouldn't be seen as something that's sort of fringe or side or antithetical. It needs to become part of your core framework. And I think sort of that has it separate is one of the most valuable things an academic program can do.
Thank you very much, Charlotte. Tracy, can I invite you back here with Bob to give us a very brief final summary of what we've heard here today? Thanks.
Sure, great. So just to re-echo, I mean, a lot of what was said, I think, before, in terms of what's lacking in business schools from Charlotte's perspective, what emerged was really this practical experience, critical thinking skills, broaden the pool of applicants. We can't forget about, really bringing that in from the onset and broadening the view and horizon. And really, I heard about both these hard and soft skills, because there's definitely the fundamentals need to be there. The fundamentals, the math skills, as we talked about, really needed to be embedded into the core curriculum. At the same time, there needs to be creative thinkers, system thinkers, who can develop these new models. And it sounds like there will be an opportunity with climate change, and especially with COVID. Now we can see how the system can change so rapidly, and really this needs to be embedded into the core curriculum. But we do have a lot of work to do, because again, like, the business schools are sort of lagging behind. So we do need not only these critical skills, but also critical thinkers and systems thinkers. Yeah.
Thank you, Tracy. Bob, final word from you before we conclude.
So just for me, thank you for organizing this. I'd just like to say I think the work, Meta, that you and Tracy are doing is critically important. I'm very enthusiastic about it, from the beginning of this. And so I remain available to help you. I'm sure that all of the panelists are available to help you. And if we can do so in any way, you know where to reach us. So thanks again. Great work.
Thank you so much, Bob, and thank you for this offer into the future. And thank you to all of you for joining here. It's been a true pleasure. I hope this is the beginning of a new dialogue. Thank you very much.
Yeah, thank you.
Thanks, everybody.
Thank you.
Cheers. Bye-bye.